All right, let's dive straight into this explainer. We're unpacking the slightly controversial, but honestly fascinating, financial strategies behind Ambev's Q1 2026 earnings. Whether you're tracking global beverage trends or just wondering how these massive corporations actually navigate today's economy, there's a lot to dig into here. We're basically looking at a masterclass in modern corporate strategy, balancing drops in physical product sales with some seriously aggressive financial engineering.
To make sense of the heavy financial data, here is our agenda. We'll start with their premiumization strategy, look at the Q1 consolidated results, do a regional breakdown, talk about the B's platform, check their balance sheet health, and finally look at shareholder returns.
Okay, Section 1, the premiumization strategy. Selling less for more.
Now, what's super interesting here is how big beer actually operates today. You think the goal is always just sell more physical cases of beer, right? Well, not exactly. Take a look at this quote from Muvendi International. It completely nails this premiumization strategy. Critics are pointing out that even though Ambev saw a 3.3% consolidated drop in volume back in 2025, higher prices are what's really driving these massive shareholder payouts. In fact, Muvendi noted Ambev handed out roughly 90% of its operating cash flow to shareholders that year. So yeah, it's a strategy that's definitely sparking some debate as everyday consumer prices keep creeping up.
So, the big takeaway here is that Ambev is strategically trading lower physical sales volumes for aggressive revenue management to just juice that bottom line. They aren't exactly panicking over a slight drop in the actual amount of liquid being sold. Why? Because they're extracting way more profit per unit. It's a calculated, deliberate pivot. They've moved from pure volume growth to sheer, unadulterated margin expansion.
Moving on to Section 2. Q1 2026 Consolidated Results, the strategy in action.
Let's check out the newly released Q1 2026 SEC filings and see how this actually played out. Do these theories hold up against cold, hard financial data? Well, spoiler alert, they really do. Reported total volumes actually dropped by 0.8% year over year, landing at about 44.9 million hectoliters. But even with that drop and a tiny 0.1% bump organically if you strip out currency and acquisitions, look at the revenue and profit. Organic net revenue shot up 8.1%, and that drove double-digit organic EBITDA growth of 10.1%.
And just to put that in context, when you see normalized EBITDA growing by over 10%, it essentially means Ambev's core operational profitability is just accelerating. It completely validates this premiumization approach. They expanded their EBITDA margin by 60 basis points across the consolidated business. That proves their pricing power is easily making up for any volume softness or rising commodity costs.
All right, Section 3, regional breakdown, where Ambev is winning.
Now, Ambev operates all across the Americas, so let's break down where these profits are actually coming from. Does this work everywhere? Well, in their home turf of Brazil, the beer segment saw modest volume growth of 1.2%. But look at the non-alcoholic beverages segment, or NAB. Volumes there dropped almost 4%. But thanks to that revenue management and some favorable dynamics in commodities like sugar and PET, they drove a staggering 16.4% growth in organic EBITDA. I mean, their gross margin in the NAB segment alone expanded by 4.4%. That is huge.
And we are seeing similar trends internationally, too. In Central America and the Caribbean, they actually achieved 7.7% organic volume growth. Meanwhile, Latin America South is like the ultimate stress test for their pricing power. Down there, they overcame a 0.5% volume dip and some massive currency translation headaches, specifically Argentine hyperinflation, yet still posted double-digit organic revenue growth of 10.2%. So the tactics might shift a bit by region, but the end goal? Protect those margins at all costs.
Next up, Section 4, the operational engine, the B's digital platform.
Because here's the thing, expanding margins isn't just about charging the customer more. It's also about spending less to get the product out the door. And Ambev is aggressively modernizing behind the scenes. They are heavily leaning on the B's platform. This is a B2B commerce platform from their controlling shareholder, ABEV, and it essentially shifts customer ordering away from manual sales rep processes to a highly efficient digital self-service model. The Ambev board even approved this deal without ABEV-appointed directors to make sure the governance was completely clean. Ultimately, B's handles order placement and significantly lowers selling and distribution costs. It's basically a digital engine designed to boost those margins even further.
Let's look at Section 5, debt, cash, and balance sheet health.
So, all of this operational efficiency, the digital transformation, the price scaling, it all leads to one massive question. After paying for all this, what does Ambev's bank account actually look like? Well, as of March 2026, they are sitting on a monster net cash position of over 16.5 billion riyals. To break that down, they have roughly 18 billion riyals in cash and short-term investments, compared to only about 3.1 billion in consolidated debt. Their cash literally eclipses their debt. In a world where companies are drowning in high interest rates on heavy debt loads, Ambev is essentially running like its own bank, which, is a pretty decent side hustle for a beer company.
Finally, Section 6, Shareholder Returns and Dividends.
And this brings us to the ultimate payoff. What does this mountain of cash actually mean for the people holding Ambev stock? Like Movindi pointed out earlier, this whole strategy is explicitly designed to fund shareholder returns. Looking at the dividend max data, it translates into a highly volatile but occasionally very lucrative dividend history. Check out these massive spikes. 15.1 cents in 2023, then a dip in 2024 to 6.87 cents, and then right back up to 15.29 cents in 2025. This kind of volatility is totally normal for special dividends, which are basically funded straight out of this premiumization cash flow whenever their balance sheet gets a little too heavy with excess cash.
In fact, they just declared another special dividend for the upcoming year. The data shows a dividend of 0.92 cents was declared on May 12, 2026, to be paid out in January 2027. This just proves a continued structural commitment to taking that excess cash and handing it right back to the market.
So, as we wrap up this explainer, the million-dollar question is this: how long can big beer keep squeezing higher margins out of lower volumes before consumers finally say enough? Ambev's Q1 2026 results prove the strategy is absolutely crushing it for their bottom line right now, heavily aided by tech efficiencies like the BEES platform. But with consumer wallets tightening all over the globe, balancing those price hikes with keeping customers is going to be the ultimate tightrope for Ambev over the next few years. Thanks for hanging out for this deep dive, and we'll definitely be watching those margin numbers next quarter.